In this tutorial, we'll analyze the feasibility of purchasing a piece of land, building 3 duplexes and 2 fourplexes on it, and then renting them. Our example property has an existing home which will be demolished. If you're new to land development, you'll want to read our 50-page insider's guide that comes with the Proforma software. It covers land development basics, tips and tricks, and explains the process step by step. For clearest viewing, I suggest full screen mode in Windows Media Player, which can be selected in the Media Player's lower right corner. This completed Proforma can be printed from the Solved Examples page on the Construction Calc website. To get started, open Excel and then open the Land Development Proforma. At the bottom of the screen, click on the Rental tab. For help and instructions, mouse over any red triangle. There is also help via the Help tab at the bottom of the screen. General information goes here if you wish. The upper part of the sheet is used for cost estimating. Use as much or little as you need. Rows can not be deleted, but they can be hidden via the plus and minus buttons in the left column, or the 1 and 2 buttons in the upper left, or via Excel's Format, Row, Hide and Unhide commands. Here I've ballparked the construction cost of a duplex. Each duplex will have 1,150 square feet of living space and a 2-car garage of 500 square feet. I've estimated $75 per square foot for the living unit construction costs, $40 a square foot for the construction cost of the garage. Of course, there will be 2 units per duplex. In the workspace column, I subtotaled the total cost of each duplex. This is the number I'll use in the analysis below. You can see the rest of the cost estimating I've done here. Similarly, I've subtotaled for each section for use in the section below. Now let's get to the rental analysis. To keep this tutorial short, I won't go over every input, but remember, instructions are available with mouse over on each red triangle. In our example, we're looking to purchase the raw land now and build on it immediately, so we enter 0 in this cell. If, however, we already owned the land, we could account for that by inputting the number of years ago we purchased it. In doing so, an existing loan section unhides. For example, 5. Here's the loan section which unhides. But in our example, we're assuming that we're going to purchase the land now, so we enter 0. In this section, we account for the value of the land and the improvements, which is likely different than the asking price. Here, we input our improvement costs from above. These can be linked to the above section with Excel's equals sign, or values can be hand entered. In this section, we account for depreciation. Here we account for one-time only income from the property, such as harvestable timber. Our property has none. This is also where we account for the cost of demolition. In our case, we're assuming $15,000. We input our land loan information here and our construction loan information here. Scroll back up. Next, we estimate monthly income from our rentals. We assume that in year 1 there will be no income because we'll be constructing the rentals. Here is our assumed rental income with vacancy for year 2 and on. In this section, we input recurring expenses. This section restates the values from previously input data that will be used in the analysis section below. You can input different values if you wish. Here we see projected annual appreciation, cash flow before tax, reduction in loan principal, and tax consequence. In the summary, we see that this project will have a negative cash flow in the first year and in each subsequent years. This means that from month to month this investment will cost us money. However, taking into account appreciation, reduction in loan principal, and tax consequences, in year 1 we have a loss, but in subsequent years we can expect a net gain of $37,000 plus. This gain would only be realized at end of year tax time and or when the project is sold. Annual ROI, or return on investment, is shown here. Again, in year 1 we show a negative number. In subsequent years we're showing a respectable return of 8.4%. Equity is shown here. This is the amount of cash we've got tied up in the project. The number of years required to recapture our cash invested is shown here. This is the amount of surplus cash we have at the project start. If this were a negative number, we'd likely consider a higher loan or more down payment. Now you can print this or go back and run different alternatives.